Hi and welcome back to my channel. So last week Google announced they want to split their stock 20-for-1. So in this video I'm going to answer loads of questions about stock splits. So I'll answer what is a stock split and why would a company want to split their stock, and I'll also answer what are the effects of a stock split. And I'll also answer everything else you could possibly want to know about stock splits. I also have timestamps in the description below this video if you want to jump ahead. If you're new here, then my name's Ollie, and on this channel we talk about all things related to personal finance and investing. So if you enjoy this video, then I'd really appreciate an early thumbs up, as it really helps with the YouTube algorithm so that my content can reach more people. Also, please subscribe and press the bell icon to be notified of the latest videos as I upload new content every week. Now, before we get stuck in, the information in this video is not intended to be financial advice, and if you want financial advice, you should seek a licensed professional. At the end of the day, I am just a guy on YouTube, so please do your own research, and also past performance is not indicative of any future results. So what is a stock split? If we look at Investopedia, the definition of a stock split is a stock split happens when a company increases the number of its shares to boost the stock's liquidity. Although the number of shares outstanding increases by a specific multiple, the total value dollar of all shares outstanding remains the same, because a split does not fundamentally change the company's value. So basically, in the sense of Google, each stockholder will end up with 20 shares for each share held before the split. This also means the number of outstanding shares in the market will multiply by 20. If you're at a broker with fractional shares, then your broker will multiply whatever fraction you have by 20 also. In general, a company's board of directors can choose to split a stock by any ratio. So this could be 2-for-1, 5-for-1, 10-for-1, or even 100-for-1. Technically, the split does not make the company more valuable, and the market cap stays the same because the share price drops in proportion to that multiple also. So in Google's case, its share price at the time of the split will be divided by 20. So as a quick example, in respect to Google, their share price costs roughly $3,000 at the moment. And because they are going to do a 20-for-1 stock split, then overall the amount of shares would multiply by a factor of 20, but the price of each share would divide by a factor of 20 to say $150, because 3,000 divided by 20 equals 150. So for example, if an investor owned 10 shares at $3,000 each, the total value would equal to $30,000 pre-split. And after a stock split, if for example that person who held 10 shares previously, they would now hold 20 times the number of shares. So they would now hold 200 shares. And if you multiplied this by the new share price of 150, then the result is the same and it would still be worth $30,000. So this type of split can also be called a forward stock split. So why would a company want to split their stock? So companies often do this when their stock price is high. Companies often choose to split their stock to make it more accessible to investors. And this is the exact reason Google gave for their stock split on their latest conference call. It makes the stock more attractive to some small-time investors who are more comfortable with lower priced shares and may have previously been intimidated by buying in at such a steep share price. For example, say a bank was $50 a share a few years back and the share price had risen and was now worth $100 a share. If other stocks in the financial sector are trading well below $100, then those stocks aren't necessarily better value, but casual investors sometimes may make this assumption. Therefore, a stock split may bring additional interest in the company's stock. But fundamentally, investors are no better or worse off than before, since the market value of their holdings stays the same. Whereas a lot of brokers nowadays offer fractional shares, many brokers still don't. And in regards to Google, buying a single share would cost roughly $3,000, which is a lot of money to pay out all at once. So it makes the shares a lot more accessible having a lower share price. This may also entice many small-time investors who flocked to the stock market during the pandemic. In addition to this, having a higher number of shares can result in greater liquidity for the stock, which makes trading the stock easier for buyers and sellers. Higher liquidity also lets people buy and sell shares in the company without too great an effect on the share price. Interestingly, there's only 27 other stocks in the S&P 500 that have a share price above $500 besides Alphabet. And there are only 7 companies in the S&P 500 that trade for more than $1,000 a share. So what are the effects of a stock split? In theory, it should have no effect on a stock's price, but it often results in renewed investor interest, and as mentioned previously, a stock may see an uptick if the lower share price attracts new investors, which can have a positive effect on the stock price. While this effect may wane over time, stock splits by blue chip companies are generally a bullish signal for investors. According to Bespoke Investment Group, between 2015 and 2020, the average price changes for stocks of companies that announced splits has been an additional 2.3% from the time the split was announced until the time it took place. Moreover, nearly 70% of these stocks outperformed the S&P 500 index during that time. While the average stock also fell 0.3% immediately after the split, over the following year, these companies gained an average of 9.8%. But bear in mind, past performance does not indicate future results, and these stock splits may have coincided with other factors that drove up the stock price. So this may not be a reliable indicator. Analysts have also speculated that the move could get Alphabet stock into the Dow Jones Industrial Average Index, which it is not currently a part of due to its high price. Entry into the index could help increase the stock's value, as it would require all the funds that track the Dow to buy Alphabet shares. Alphabet is not currently in the Dow because the Dow is weighted by share price, and at its current price would overwhelm all the companies in the index, whereas at $150 a share, it would become a much more appealing candidate for inclusion. The move by Alphabet is also putting pressure on Amazon to look into a stock split, as they haven't done one since 1999, and their shares are currently around $3,200. So will the stock split for Alphabet affect all different classes of Alphabet? Well, you may or may not know Google has 3 different classes of stock. Class A, which are single vote common shares. These shares have been available to investors since Alphabet went public in 2004, and these trade under ticker GOOGL. Then Class B shares are non-publicly traded shares. These are controlled by insiders and come with 10 votes per share. And lastly, they have Class C non-voting publicly traded shares. These shares were created in 2014 following an unconventional stock split, and they have no voting rights, and they currently trade under ticker symbol GOOG or GOOG. All 3 classes of Alphabet will be split 20-for-1. So when will Google's stock split occur? So following approval by Alphabet shareholders, owners of stock will receive their additional shares on Friday, July the 15th, and Alphabet will trade under its new price when the market reopens on the 18th. So how many times can a stock split? Theoretically, a company can do this as many times as they like. So for example, Microsoft split their stock 9 times between 1987 and 2003. However, since there is paperwork involved, companies will most likely only split stocks when they feel like it is a good and timely decision for their business. So when does a stock split? There is actually no fixed formula for this. Some companies split their stock price every few years, providing they are growing, while others refuse to split their shares no matter how high the price goes. When it comes to timing, companies will usually allow at least a few weeks or even months between the announcement and the actual split. What do you need to do about a stock split if you hold shares of a company? You don't actually need to do anything, and your broker will handle this automatically for you on your behalf, which is very nice of them. Thank you very much, brokers. What happens if the company that is splitting their stock pays dividends? Well, whereas Google doesn't pay dividends, if a company does, then the dividend per share is adjusted accordingly, therefore keeping the overall dividend payments the same. For example, if you were getting $2 per share pre-split and a company was doing a 2-for-1 split, you would now get $1 per share. But most companies avoid announcing a stock split close to the date of record in order to avoid any confusion. So what happens if you're shorting a stock and they go through a stock split? Well, firstly, if you don't know what shorting is, then I recommend you check out my video up here, and I'll put the link in the description below. But as a quick overview, you're betting on the share price going down. So on the surface, a stock split may seem like you're making easy money, but unfortunately your broker will adjust your order so the stock split doesn't affect your position. What happens with stop losses? If you don't know what stop loss is, then I recommend you check out my video up here, and I'll put the link in the description below. But stop losses are generally a way to instruct your broker to sell a stock if it goes below a certain value. But it's worth noting, you shouldn't assume your broker will adjust the stop loss price following a stock split. In most cases, the stop loss is simply voided, so you'll have to place a new stop order. Can you sell your additional shares when you receive them? Of course you can, which is great if you're at a broker that doesn't offer fractional shares, because say for example, you currently held one share of Google at $3,000, then if you sold one share, you would have to close your entire position. But after a 20-for-1 split, you could now reduce your holding without selling up your entire position. So what is a reverse stock split? A reverse stock split is the opposite of a forward stock split. This is where a company lowers the number of shares instead of increasing them, and instead they raise the share price accordingly. As with a forward stock split, the market value of the company stays the same. Companies sometimes do a reverse stock split if their share price has decreased to a level at where it runs the risk of being delisted from an exchange for not meeting the minimum price required for a listing. In a reverse stock split, if a shareholder has 5 shares and the reverse stock split is 4-for-1, then they would end up with 1.25 shares. In this case, if your broker doesn't offer fractional shares, then they may liquidate the fractional share and give you the difference in cash. However, if you use eToro, then fractional shares would be given out as eToro supports them. So that's it for this video. Let us know below if you prefer buying shares below a certain value, and will you be buying more Alphabet ahead of their stock split? I'd love to know, and I read all your comments. If you got any value from this video, then please smash the like button, as it really helps support the channel massively. Also, for those of you interested in signing up to eToro and haven't already, then there's an affiliate link down below this video, where if you do sign up, then I will get a kickback, and it doesn't cost you anything extra, but it really helps support this channel. And if you want to learn more about personal finance or investing, I recommend you subscribe and press the bell icon so you don't miss out on any future updates, as I upload new content every week. It's been Ollie from Get Geek Finance. Thanks for watching, and I'll catch you in the next one.